Welcome to the accounting class.
In this session, I'm going to give you a brief introduction to a banking reconciliation. We shall start by asking the question, what is a bank reconciliation and why is it important? When we record transactions that involve a bank in our accounting records, we are recording all the receipts that are paid into the account and all the payments or transfers that are made from the account. When we receive a bank statement, we are getting a record of all the payments into the account that the bank has recorded and all the requests for payment received by the bank as a result of our signing of cheques or authorising electronic transfers and other payments. A bank reconciliation is a method of matching these two sets of records and being able to recognise any differences that might exist. It is standard practice to carry out the matching process of reconciliation as soon as the bank statement is received. For a small business with a few transactions, this can be left until the receipt of a hard copy of the statement. Businesses with many transactions might prefer to do this at any time. The facilities are now available to do this since online statements can be obtained at any time 24/7. Try and remember your last bank statement and think about all those things that were printed out for you. Let's start at the very beginning, a very good place to start. The first item presented is the balance at the start of the period in question, which may be referred to as a balance that is brought forward or carried forward, or it may be called the opening balance for the period. This will show how much you have remaining in that particular account, unless you are unlucky and it shows that you actually owe money to the bank. The statement will then show payments, cheques you have written out and which were presented, debit card transactions that have gone through the system, EFT payments made from your account, transfers you might have made to another account. It will also show the cheques and the cash that you have paid in and any EFT payments received by the bank for your account. A point to note here is that the cheques and other transactions may not be in the order you expect. You may write out and use cheques according to cheque numbers. They may not be presented to the bank in that order. The bank may also have included its own charges. Many business accounts will have charged a rate per cheque presented and possibly a fixed charge for services. They may charge interest on an overdraft, or they may pay interest on the average balance in the account during the period in question. If you are really unfortunate, there may also be entries for cheques returned for NSF reasons. NSF means there were not sufficient funds in the account for the payment to be received. Most of us are familiar with the term describing these as rubber cheques and saying that they bounce when they are presented for payment. The last line of the statement will show the balance at the end of the period in question. When you compare the balance on the statement with the balance that you have in your accounting records, you may well find that they are different. The task in reconciling is accounting for the differences. To start with, we need to think about why the differences occur. We have already alluded to the first of these when we talked about presenting cheques. These are called timing differences. If you pay money into a bank on the last day of the month, then it may well be that they do not get entered to your account the same day. If they are paid in via machine facilities on Saturday, it may not be until Monday that they are entered to your account. You might also note that on your statements the entries may be listed as deposits and a sum entered for the total deposits. When entering receipts to a computerized accounting system, it can be useful to enter items in such a way that the total of the deposits appears on your system in the same way that it's likely to appear on your bank statement. The most frequent timing differences relate to cheques not being presented immediately. A business may choose to pay in cheques at the end of each week. Some seem to wait even longer. This means the cheques listed as presented on your statement are rarely in the same order that you issued them and may not appear until the statement for the following month. A second difference between the balance on your statement and that in your accounts can be because the bank has entered its charges for services during the period, or the interest paid to your account during the period. A third difference arises because it may be that payments received or paid by EFT, that's electronic funds transfer, appear first on the statement. And of course the fourth difference can arise from NSF checks where a rubber check has bounced. A possible fifth difference can occur because the bank has made a mistake with an entry. We shall now have a short case study. The bank account records from the ledger of a dry cleaner are shown. The opening and closing balances are shown, 2 checks have been issued and 2 deposits made. The bank statement also shows an opening balance and a closing balance. Look carefully and you will see that only 1 check has been presented and only 1 deposit is recorded. In addition, there are 2 entries that do not appear in the accounting records. Charges made by the bank and an EFT payment from a customer that has been received. There is an easy procedure that a lot of accounting personnel use for performing a bank reconciliation. Start with the idea of ticking off all those items that you can find both on the bank statement and on the accounting records. On the bank account record in the ledger, 1 check and 1 deposit can be ticked or checked. Obviously, the same 2 items must be ticked or checked on the bank statement. The second step is to update the bank account in the ledger with the entries from the bank statement, having checked that the entries are correct transactions. One of the entries was for bank charges. To enter these to the account, we write a journal entry. We debit the account for bank charges expense with $10 and credit the bank account with $10. The journal would then be posted to the accounts. The source of the EFT payment is identified. Dolby is a customer who receives credit terms and makes payments through use of EFT. Dolby is therefore a debtor. The journal would debit the bank account of the general ledger and credit accounts receivable. An entry would also be made to Dolby's account in a sales ledger to show the amount owed had been reduced by the payment. We now have an updated bank account in the general ledger that reflects the additional entries identified from the 2 transactions that were on the bank statement. We have a revised figure for the closing balance for the bank account in the general ledger. The next step is to identify any deposits in transit. We can identify the deposit of $1,500. Now identify the outstanding checks. These are the checks sent that have not yet been presented to the bank. We can identify check 101 for $1,400. We now have all the information that is needed to set out the bank reconciliation statement. The statement is headed with the title and date to which it refers. Our statement is for the end of January. We open with the balance on the bank statement on January the 31st. Then we add to that total the sum of any deposits in transit. In this case it is the deposit of $1,500. Then we subtract the check that has yet to be presented. In this case it is the check for $1,400. That gives us an adjusted balance for the bank statement. The last line will show the balance for the ledger account. The adjusted balance and the balance for the ledger account should be the same. This means that we have successfully carried out our bank reconciliation. A record should be kept of the bank reconciliation statement. This ends our session on bank reconciliation. Thank you for watching and for listening.